Welcome to the debate. Welcome to breaking news to trading moves. When you watch climbers attempting to summit Mount Kilimanjaro, the environment quickly becomes incredibly hostile. The air gets remarkably thin. The body practically screams at you to stop.
Right, it's absolute agony.
Yeah, exactly. Every single step up that rock face is an exercise in absolute suffering. And it begs the question, who actually makes it to the top? Is it the person with a biological advantage who naturally processes oxygen better and simply has an inherent tolerance for the physical pain? Or is it the climber who rigidly follows a calculated system?
Right, like taking exactly 30 steps, pausing for breath, and obsessively managing their oxygen tank, completely regardless of how they happen to feel in that exact moment.
Exactly.
Well, I look at that climber and see an entirely different dynamic at play. The mountain doesn't care about their feelings, their grit, or their pain tolerance. The environment only rewards rigorous preparation and unyielding adherence to safety protocols. If you rely on your innate ability to endure pain on a mountain, you eventually run out of endurance. You need the system.
And that exact tension brings us to the central question of our debate today. What is the true driver of consistent profitability in financial markets? I argue that inherent psychological traits and neural wiring elements like natural pain tolerance, neurological sensation seeking, and inherent grit are the absolute foundational drivers of trading success.
And I counter that structured discipline and hard-coded risk management frameworks supersede any raw psychological predisposition. You can have all the natural grit in the world, but without an external framework, the market will break you.
Let's start by looking closely at who actually chooses to trade professionally and how their brains are quite literally wired. Traders display one of the most extreme personality profiles you will find in the professional world.
The data on that is wild, yeah.
It really is. When we measure them on the Big Five personality scale, the numbers jump right off the page. They score in the 87th percentile for sensation seeking and the 29th percentile for neuroticism. What that tells us is they are biologically built for environments that would paralyze most ordinary people.
Sure, but it goes well beyond just thriving on volatility, right?
Right. It comes down to a specific behavioral trait psychologists identify as grit, which is the sustained effort toward a goal despite repeated punishing setbacks. Experimental evidence shows that innate grit directly reduces loss aversion.
Loss aversion being that cognitive bias we all have where the pain of losing $100 feels twice as intense as the joy of making $100.
Exactly. Gritty investors exhibit a 15 to 24% lower disposition effect. Now, for anyone listening who has ever stared at a blinking red P&L, you know the disposition effect.
Oh yeah, we all know it.
It is that incredibly destructive habit of selling your winning positions way too early just to lock in the green, while holding on to your losing positions for way too long because you're hoping they bounce back. Because gritty individuals are naturally more willing to accept defeat and exit losing investments, they ultimately generate about 7% more wealth. They possess a neural architecture that allows them to process risk differently than the rest of the population. They just don't feel the same sting when they cut a loss.
I mean, I come at it from a completely different direction. Relying on raw psychological traits without strict external constraints inevitably leads to burnout, overtrading, or outright gambling behaviors.
You think grit depletes?
Well, yeah. Motivation and grit are finite resources. They deplete throughout the day. Discipline, however, builds the external habits that actually retain wealth. Long-term survival relies entirely on external systems, specifically the models utilized in proprietary or prop trading.
The prop firm models.
Right. In the prop firm environment, capital preservation is prioritized over aggressive growth. Success there is manufactured through hard-coded rules, not personality tests. We are talking about strict mandates, like risking only 0.5% to 1% of your total account equity per trade, and strictly targeting a 1-to-2 or 1-to-3 risk-to-reward ratio.
But you can't manufacture a profitable trader just by handing them a rulebook.
You absolutely can, if the rulebook enforces the boundaries of their behavior. By mathematically enforcing those exact parameters, you completely strip the emotional vulnerability out of the decision-making process.
I see. So the system just overrides the human.
Precisely. You don't need to be a psychological marvel or possess an iron will if your platform automatically halts your trading the moment you hit a predefined daily loss limit. The system steps in and protects the trader from their own volatile psychology. You're outsourcing your discipline to a machine.
Okay, wait, so let me make sure I'm grasping your angle here. You're saying that by setting these strict daily loss limits and hard-coding risk parameters, the trader effectively doesn't need to possess any elite psychological traits? That the system does all the heavy lifting?
Exactly. The system acts as the guardrail so the human doesn't have to constantly flex their willpower.
I see why you think that, but let me give you a different perspective on how that psychology actually functions in real-time execution. Let's look at sensation seeking, which I consider a vital, required asset, not a liability that needs to be caged.
A vital asset?
Yes, we have brain imaging studies of non-traders viewing level 2 market data that indicates an immediate potential financial loss. When non-traders see that data, their threat response networks light up. It is pure biological panic. Their amygdala takes over.
Sure, the fight or flight response.
Right. But when elite traders view that exact same order flow data, their brains activate analytical processing networks. The exact same information is processed through entirely different neural pathways. That is not something a risk management rulebook gives you. That is biological hardwiring.
But that assumes the market is always providing that high-stakes environment for them to process.
Well, consider a flash crash scenario. When the market drops 3% in 10 minutes, the average person freezes. But traders scoring above the 80th percentile in sensation seeking actually generate 23% higher returns during those extremely volatile markets.
They lean into the chaos.
Exactly. Their brains are finely calibrated to perform under the exact chaotic conditions that completely impair others. They lean into the chaos to find the mispricing rather than freezing up in fear.
That is a compelling angle, I'll admit. But have you fully considered the dark side of that exact same neurological coin? I call it the boredom problem.
The boredom problem?
Yeah, you have to account for the fact that these exact same high sensation seekers generate 31% higher losses during periods of low volatility.
Ah, so you're saying their superpower becomes their weakness when the market slows down.
Exactly. When the market is quiet, when we are in a tight, choppy range for weeks, their brains treat the lack of price action like clinical sensory deprivation, and the behavioral consequences of that are highly predictable and incredibly destructive.
They start taking forced trades.
Yes, because inaction feels physically intolerable to a high sensation seeker. They begin overtrading. They start taking poorly constructed positions, not because a genuine statistical opportunity exists on the chart, but simply because their brain demands the stimulation.
They are essentially trading just to feel something.
Right. And that leads us to the mechanics of behavioral addiction. Trading activates the exact same dopaminergic reward pathways as gambling. It operates on what psychologists call a variable ratio reinforcement schedule.
Let's connect the dots for the listeners there. What does a variable ratio reinforcement schedule actually look like in practice?
It is the exact same psychology as pulling the lever on a slot machine. You never know when the payout is coming, and you never know how big the payout will be. Sometimes you win a little, sometimes you lose, and sometimes you hit the jackpot.
Which just scrambles the brain's reward system.
Completely. That unpredictability completely hijacks the brain's dopamine system and creates a compulsive loop. It makes the activity inherently addictive, especially for the exact sensation-seeking profile you are praising. Without the strict daily loss limits and position sizing rules of a prop firm to act as a cage, that sensation-seeking trait actively destroys the account. They will feed the machine until they are wiped out.
Well, I completely acknowledge that boredom and the need for dopamine can lead to critical errors. But to survive those inevitable errors and to survive the drawdown periods that every trader faces, you need a high pain tolerance. And pain tolerance is the ultimate separator of talent in the markets.
Pain tolerance over risk management?
Yes, because we can relate emotional pain tolerance directly to financial equity. Equity acts as a literal physical buffer against market losses. If taking a loss translates directly to emotional pain, then having the ability to absorb more losses before giving up means you have a higher pain tolerance.
Connect the emotional pain to the balance sheet for me.
Think back to that mountain climber, the individuals who can endure the pain of severe portfolio drawdowns, who can sit with that pain the longest without abandoning their overarching strategy, are the ones who succeed. The market richly rewards those who have the fortitude and the personal equity buffer to sit through the absolute worst of the pain.
But people get shaken out all the time.
Right. People with low pain tolerance get shaken out at the very first sign of trouble. They panic sell at the absolute bottom. You cannot systematize the endurance required to watch a portfolio bleed red for weeks. That requires a profound, innate internal fortitude.
I just don't buy that. Let me tell you why relying purely on human pain tolerance is reckless. Let's extend your mountain climbing analogy. Strict prop trading rules are not just a suggested walking pace.
What are they then?
They are the physical safety harnesses used by those climbers. A climber doesn't rely solely on their raw grip strength to survive a sheer drop. Why? Because human muscle eventually fatigues, the grip fails, and the climber falls to their death.
So the rules are the safety net?
Exactly. Just as a trader should never rely solely on their emotional endurance to survive a sudden market crash, human pain tolerance always fails eventually. Everyone has a breaking point where the pain becomes too much and they liquidate everything in a panic.
So how does the prop firm model solve the reality of a trader hitting their breaking point?
By removing the need for pain tolerance entirely. This is exactly why prop firms mandate a metric called maximum adverse excursion, or MAE, and utilize trailing drawdowns.
Walk us through how a trailing drawdown functions on a typical trading day.
A trailing drawdown follows the high water mark of your account equity. Let's say you start with $100,000 and your drawdown limit is $5,000. If your account drops to $95,000, you are cut off.
Simple enough.
But if you make $2,000 in profit, pushing your account to $102,000, your liquidation floor moves up right along with it to $97,000. The firm doesn't ask the trader to painfully tolerate giving back all those newly acquired profits.
The system simply cuts them off the moment they hit that trailing floor.
Yes.
It replaces the exhausting need for emotional endurance with a cold mathematical boundary.
But those mathematical boundaries only work if the human operating the mouse has the specific personality required to actually adhere to them. If we look at the Ocean Big Five personality model, openness, conscientiousness, extroversion, agreeableness, and neuroticism, we clearly see that decision-making styles under stress are deeply tied to innate traits.
And how do those profiles interact with the rules I just described? Take the Stoic profile, which is characterized by low agreeableness and very low neuroticism. This person naturally detaches from gains and losses. They don't take a red day personally.
So they can follow the system?
Right. They can execute your trailing drawdowns and your strict prop firm rules completely seamlessly. But contrast that with the compulsive or intuitive emotional profiles, who exhibit high extroversion and extremely high neuroticism. Their choices are driven entirely by fear, doubt, hope, and ego.
They move their stop losses.
Exactly. If you're listening to this and you've ever found yourself moving your stop loss just a little bit further away because you felt the stock would bounce back, that isn't a strategy choice. That is your biological stress response hijacking the wheel.
But you can train that out.
I disagree. You cannot simply hand a highly neurotic person a list of prop firm rules and force them to act like a stoic. Under intense pressure, their biological stress response will override the external framework. Their natural personality will always reassert itself, and they will break your rules.
Well, that entirely assumes that emotional regulation is a static, immovable trait. But elite emotional regulation is a trained skill, not just a genetic lottery ticket you are born with. Let's look closely at the practice of effective forecasting.
Effective forecasting? How does predicting your feelings apply to managing a level 2 order book during a volatile session?
Effective forecasting is the practice of actively predicting your emotional state in future scenarios and pre-committing to your decisions before the emotional arousal ever occurs. It changes the entire paradigm of discipline.
So you make the choice before the market even opens?
Exactly. A trader decides if this position drops 5%, I will immediately sell. But they make that decision during the weekend, during a period of completely calm, rational analysis. By hard-coding that rule directly into their broker platform, they execute the decision during a chaotic Tuesday morning market crash without ever needing to flex their emotional muscles in real time.
Wait, let me highlight what you just said because well, it changes the way we look at this entirely. You are saying that discipline isn't about having strong willpower in the moment of panic. It's about making the decision when you are calm so that willpower is entirely unnecessary during the panic.
Exactly. You are removing the human element at the moment of execution. We see this perfectly illustrated in the world of quantitative traders. Quants typically show a very unusual psychological profile, extremely high conscientiousness, and very low sensation seeking.
They just build the algorithms.
Yeah, they literally automate the emotion entirely out of the process. They write the algorithms when their brains are in a cold, analytical, low arousal state. Then, they simply let the machines execute those algorithms during the hot, chaotic, high arousal market hours. The quantitative approach proves that systematic, forward-looking planning defeats volatile human psychology every single time.
That is a brilliant way to frame it, though I would argue you are still proving my overarching point. Even the quantitative trader is relying completely on their specific innate personality profile, their unusually high conscientiousness to possess the diligence to build, backtest, and actually trust that automated system in the first place.
But the system is what executes the trade.
Sure, but you are assuming that rules enforce themselves simply because they exist. A rule is just a line of code on a screen or a sticky note attached to a monitor, until a living, breathing human being makes the conscious choice to respect it. But if the rule is hard-coded into the execution platform, the human doesn't have a choice. The platform closes the trade until the human decides to override the platform, or disable the daily loss limit, or fund a secondary account to revenge trade. Think about the concept of the Ulysses Pact. In the myth, Ulysses knew the siren song would make him steer his ship into the rocks, so he had his crew tie him to the mast, and he plugged their ears with wax.
He built an external system.
He created an unbreakable external system, but he still needed the profound self-awareness and the innate conscientiousness to recognize his own fatal weakness and bind himself to that mast before the ship set sail.
I see what you mean.
Right. My argument is that a trader's underlying neurowiring, their grit, their sensation-seeking drive, and their inherent tolerance for discomfort dictates their ability to actually build and honor those tools. Risk frameworks and trailing drawdowns are undeniably valuable, but they are only tools. The innate psychology of the trader is the bedrock foundation upon which any system must be built. If the foundational wiring is fragile, the most elegant risk management system in the world will ultimately be bypassed, overridden, or completely ignored when the trader is staring down genuine visceral market terror.
Well, and my position remains that precisely because human psychology is so incredibly fragile, so volatile, and so deeply prone to behavioral addictions under stress, those external systems are paramount. We know definitively that the dopamine hits from variable ratio rewards make trading inherently addictive. It is a biological fact.
Yeah, the cortisol levels are through the roof.
Exactly. Active traders report higher rates of elevated cortisol and utilize destructive coping mechanisms to manage the relentless adrenaline cycle. We absolutely cannot rely on something as fluctuating as human motivation or willpower to protect a portfolio. Strict, rule-based frameworks, pre-planned affective forecasting, and automated hard-coded guardrails remain the only truly reliable mechanisms for long-term capital preservation. Habits build wealth, and enduring habits are formed exclusively through rigid systemic constraints that protect the trader from their own flawed humanity.
I think where we ultimately find our convergence today is in recognizing that unmanaged emotion is the absolute primary enemy of wealth accumulation.
Absolutely.
Whether that emotion manifests as the disposition effect, selling winners early and holding losers, or as frantic revenge trading after a stopout, or even as clinical behavioral addiction, letting immediate emotional reactions dictate your execution is completely fatal to a portfolio.
I completely agree. The sheer, crushing, psychological pressure of the financial markets will ruthlessly exploit any vulnerability you bring to the terminal. We clearly both see immense value in a trader taking the time to deeply understand their own psychological profile. If you know where you fall on the big five traits, like if you know you are high in neuroticism or prone to sensation seeking, you then know exactly which systemic mathematical guardrails you need to build around yourself to survive.
Exactly. The self-awareness dictates the system. There is clearly much more to explore regarding the precise mechanisms of how the human mind interacts with financial risk, and we will leave it to our listeners to evaluate their own trading behaviors and form their own conclusions. As you navigate your own markets this week, remember those climbers on Kilimanjaro. Whether you are relying on the iron will of your innate endurance or you are leaning entirely on the unbreakable rules of your oxygen system, the mountain remains unforgiving. Thank you for joining us.